morning, Trinidad and Tobago. Good morning, Jesse, and welcome to the Bourse Report. Well, today we're taking a look at the half-year mark, of course, at the performance of local and international stock markets. Now, it's been quite a roller coaster ride over the past 6 months, and the dominating factor has, in fact, been, unsurprisingly, the effects of COVID-19 on the global economy and financial markets. So how would that have impacted local and international equities over the first half of the year, and what's in store for the second half of 2020? Well, let's take a look, and we'll start firstly with the local market. And for the year thus far, or the first half of 2020 rather, it's been again a very topsy-turvy first 6 months or so. The Trinidad and Tobago Composite Index, as measured in that red line, was down year to date at 10.7%. Now, quite surprisingly, the cross-listed index, which has usually been a very positive impact, or had a positive impact on the composite index performance, was down actually just around 20.5%, driven by price declines of some of its major constituents, and we'll get to that shortly. The All TNT index, after falling as much as 10%, has stabilized somewhat, and in the context of a very turbulent economic and operating environment, is down just around 5.3%, which isn't entirely bad against the backdrop of COVID-19 and its particular impact. When we take a look at some of the major movers on the Trinidad and Tobago Stock Exchange, we can see that National Flour Mills has actually been one of the best performers for the year thus far, up 38.5%, and that's on the back of, well, more domestic demand, certainly, and a doubling of its first quarter earnings. And most of that would have been driven by the lockdown and some change in consumer patterns. Republic Financial Holdings Limited was up 6.3%. Trinidad Cement Limited, despite the shutdown in construction activity for some period of time and a waning economic activity as forecast by the IMF, with negative growth in Trinidad and Tobago in the order of 4.5% to 5%, was still up around 5%. TCL, Trinidad Cement Limited, that is, and Merchant Bank and First were up just over 3% as well for the first 6 months. On the downside, GMMB Group Limited, one of those cross-listed stocks, was down just around 24%. Unilever Caribbean Limited down 26%. Trinidad and Tobago NGL Limited, was down 27%, followed by NCB Financial Group, another cross-listed stock, down 27.7%, and One Caribbean Media, or OCM, was also down 35%, which was generally more reflective of the investor sentiment over the first half of the year. In fact, over the first 6 months, just 7 stocks on the Trinidad and Tobago Stock Exchange were in positive territory, and you saw the top 5 of them there in this particular illustration. Now, in terms of local market drivers for the next 6 months and probably beyond, we have some positive and negative drivers. On the positive side, there has been fiscal and monetary stimulus. Fiscal stimulus in terms of social grants that have been given or are available, as well as support to the SME sector and credit union sector to promote financial stability, as well as control credit risk in the overall banking and financial services system. In terms of monetary stimulus, we've seen the central bank slash its repo rate from 5% to 3.5%, as well as lower its required reserve ratio from 17% to 14%, to improve liquidity, as well as probably make it a little bit more affordable, or create an environment of more affordability for those persons who do need to borrow, who would like to borrow, and perhaps stimulate the economy to some extent. The containment of COVID-19 cases has been quite positive for Trinidad and Tobago, notwithstanding the recent spike. And that has facilitated largely the economic reopening. On the negative side, well, that fiscal stimulus comes at a price, and that price is rising debt levels. And expected debt to GDP is forecast to come in at over 70%. And investors will be looking on to see if that materializes and how it will be controlled. HSF drawdowns has been another factor, which would be promoting fiscal stimulus. There was a recent $400 million drawdown in May, and there was approval for another $200 million US drawdown sometime in June. And we will wait to see when that will take place, or in fact, if any additional drawdowns take place between now and the end of the fiscal year. The contracting economy, of course, isn't good news. and that will be driven by lower forecast energy prices, which will result in some underperformance of the energy sector, and that should spin off as well into some non-energy sector weakness, which could create a fairly lackluster environment in the months ahead for investors and we on investor sentiment. Internationally, global stocks have recovered over the second quarter of 2020. If you look at the green columns there, the US market was up just around 19.6%, posting one of its best quarterly performances in history. Asia ex-Japan, as measured by the MSCI Asia ex-Japan ETF, or exchange traded fund, was up 15.8%. Europe was also up 15.3%. And Latin America was up just around 18%. Now take that with a pinch of salt, because that was the second quarter performance, falling quite dismal. First quarter performances at the half year mark, the US is still down just around 4.2%. Asia ex-Japan was down just around 6%. European markets, as measured by a European exchange traded fund, was down around 14%, and the Latin America market, as measured by one of the more popular Latin American exchange traded funds, was down still 56.5%, despite those quite commendable performances in the second quarter. Now, what's going to drive markets in the second half of the year and possibly even longer at the international stage? Well, again, fiscal and monetary stimulus has done a lot to arrest dwindling investor confidence. Economies have been reopening, but there has been a case, or there seems to be evidence of a second wave of cases rising at the international level. And of course, all the vaccine development or development of a cure for COVID-19 is one of the major drivers which would boost investor confidence in the short term. On the negative side of things, rising debt levels, changing consumption patterns because of lower consumer and investor confidence. That second wave of cases we mentioned. Permanent industry damage, will air travel, for example, and vacationing be the same? And one additional factor is US election uncertainty as we get closer and closer to November, whether one of the major economies in the world and that leadership change or possible leadership change could lead to changes in policies. Those would all be potentially negative drivers for the year ahead. So certainly, there has been some positive momentum over the past quarter, but investors will be looking on keenly to see where the next 6 months to 12 months take us, and those are some of the key drivers. Now, if you'd like to learn a little bit more and dig a little bit deeper into what has happened and what could happen and how you can position your portfolio, why not check out our totally free webinar, which takes place this Tuesday on the economy and markets looking ahead at 2020, the 8th of July, this Wednesday at 2 p.m. And for much more information, you can on this and any other investment teams, you can check us out at boursinvestment.com, email us at invest@boursefinancial.com, or give us a call at 226-8773. That's 2BOURSE. But that's it for this week's edition. Have yourselves a very wonderful investing week. This has been the Bourse Report.